Hey everyone, welcome back to the channel. I'm Doug, the retirement guy, and today, which ETF is better for growth position of your retirement portfolio? The Charles Schwab SCHD or the amplified DIVO? Well, at first glance, it's a look like a simple dividend ETF comparison. While SCHD currently offers a distribution yield around 3.3, and DIVO advertises a higher monthly distribution rate around approximately 4.8. But as I always say on this channel, yield is only a number. Total return is the ultimately grows your retirement portfolio. So we're going to break it down today and go over the past 12 months that one of these funds delivered substantial more price growth and total return than the other. So we're going to break those all down to you. So grab your mug, pour your favorite beverage inside of it, sit back, relax, and let us do the driving to tell you about the income, the growth, the total return, and the taxes of the Charles Schwab SCHD and the amplified DIVO. Now, before we go forward, important disclaimer we have to do. This is for educational entertainment purposes only. This is not financial advice. Past performances do not guarantee future results. If you need financial advice, always contact a financial advisor, as investment involves risk. Hey guys, before we go any farther, I got to do it. You know, you guys have supported this channel tremendously, and I appreciate it. From the bottom of my heart, I really do appreciate what you do. For us to be able to put these videos on, the simplest little thing of owning a coffee mug, our 11 ounce or our big 15 ounce makes a difference. I make it simple. You can use the QR code. You can use the link down below. You can see all the products that we actually offer. We don't advertise all of them, but basically, I am able to be unbiased on everything I do because of this simple little thing. Thank you for your support. Also, you can always support us in the Patreon and get our monthly newsletter as well. But this is another area that keeps us being unbiased across the board. Thank you so much. The retirement growth bucket. In my 3-bucket retirement system, every dollar has a job. The foundation bucket provides liquidity. The income bucket generates a retirement paycheck. And the growth bucket is responsible for long-term capital appreciation and helping the portfolio keep pace with inflation. That means the 3 objective of the growth bucket is not necessarily to produce the highest current distributions. Its job is to increase the value of the portfolio over time. Now, income is always welcome, but income should not come at the expense of too long of long-term upside potential. This is why it's extremely important when we compare SCHD and DIVO to understand that distinction between the two. Now, yield. Yield is the number one people will always talk about in yield across the board. Okay? Yield is only a number. Yield is only one number. Total return is the ultimate what grows your retirement portfolio. So when I talk to people so many times, they immediately want to talk to me about yield, yield, yield. I'm like, great, what's the total return? I answer it always the same way, not being a smart aleck. I just say, what is the total return number? Okay? So looking at these two, if yield was everything, we'd stop the video now. Probably be my shortest video ever. That DIVO wins at 4.80% monthly distribution rate to Charles Schwab's 3.30. Okay? But high distribution does not equal a better retirement growth investment. What we need to know is the strategy, the yield frequency, the share price growth, the total return, the expenses, and then we're going to see how it handles a $10,000 illustration and the bucket of the growth. So let's talk about Charles Schwab's SCHD, of the structure, the strategy, how it works. It is a passively managed fund that tracks the Dow Jones U.S. index, dividend index. As of July 26, SCHD held approximately 103 companies and charged an expense ratio of only 0.06, which basically, guys, means investors pay approximately $6 for every year that they have $10,000 invested. That is a miracle. That is amazing. Okay, companies that enter SCHD must pass several screening tests. And those tests of the underlying general index requires 10 consecutive years of dividend payoffs, significant market capitalization. They need to have adequate trading liquidity, and eligible companies are evaluated by using 4 major fundamental characteristics: cash flow, return of equity, dividend yield, and 5-year dividend growth. So it's not easy to get into Charles Schwab's bucket. It is very, very difficult. You have to have your stuff together to make it work. Okay? The highest ranking companies are selected from the index. Real estate investments are excluded. So SCHD is not simply buying 100 stocks that's at the highest yields. They're trying to identify the most profitable companies from income and financial situations. Now, DIVO on the other side is Amplified CWP Enhanced Dividend Income ETF. Unlike Charles Schwab, DIVO is an active managed portfolio. The portfolio managers select the high quality, large cap companies with histories of dividend and earnings growth. DIV then supplements those stock dividends by tactically selling covered calls on individual holdings. The covered call strategy provides a second potential source for cash flow. When DIVO sells a call option that collects those premiums, the premiums can help support the fund's monthly distributions and may provide a limited cushion during flat or moderate declining markets. But covered calls come with a trade-off. When a stock rises above the option strike price, part of the stock's upside can be surrendered. So DIVO doesn't automatically write calls on every position all the time. The managers decide which stocks to overwrite and when they do it. So that makes DIVO less aggressive than a fully covered call fund, such as one that continuously writes over and overwrites the entire index. However, the option strategy can still reduce that potential upside during powerful bull markets. Now, DIVO has held approximately 33 different positions as of July 24th of 2026. And they charge a 0.56 expense ratio. So that's $56 off of that $10,000 invested. Huge difference between the two. Now, therefore, the cost of DIVO is about $50 more than Charles Schwab. And the difference may sound enormous in 1 year, but expenses compound over time and directly reduce your investors' retained earnings. So if these are designed for long-term holds, well, already you can see there's an advantage with Charles Schwab. So let's talk about the comparison of yield. We talked earlier about this, and I said if yield was the magic number, we would have ended 10 minutes ago. But here's the answer. Charles Schwab has a 3.3 trailing 12-month yield. Now they pay out quarterly, so that's a big difference between the two. DIVO pays out monthly, okay, and pays 4.80%. So personally, I like DIVO better than I like Charles Schwab at this point because the income winner is going to go to DIVO. Now, what does that mean for us? DIVO's distribution can include stocks, dividends, option income, capital gains, and return of capital. So there's some taxes that we'll need to talk about. So as we just talk about yield, okay, DIVO's going to win. But remember, you know me, this is a growth package, so it's okay to have some income. And it's okay to wait quarterly, but monthly is always nicer. Let's take a look at the 12-month price growth. This is where the market makes a major change. Over the past 12 months, this is June 25th to June 25 to June 26. I want to be exactly the same 12 months. Charles Schwab went up 19.7%. DIVO went up 7.4%. Another huge difference between the two. Okay? You're talking easily almost 2.5 times more growth in Charles Schwab than it did in DIVO. So is it a better package? Is it a better positioning of Charles Schwab? Well, Charles Schwab's leaning more towards this one in the appreciation game. But here's where we got to talk is total returns. Because you got to add in that big monthly income that DIVO has in their marketplace. So when we take a look at total return numbers, and this is why I always tell you guys, total return is everything. Charles Schwab came in at 24.03%, while DIVO came in at 14.71%. So that double the growth side of it that we talked about is only a 9.32% difference between the two. Charles Schwab outperformed DIVO by 9.32%, despite DIVO's higher monthly yield. So if you're putting this in the growth fund, I gotta tell you guys, is numbers don't lie. Things are very simple. Where would you put your money? And that'd be in the Charles Schwab for getting an extra 9.32% growth. Forget about the money. We're not dealing with income. That's why that yield and that monthly payoff sounds great, looks great, sounds exciting. But if you're not rolling that back in, if you're not dripping it back in, you make an even bigger difference between the two because of that 2 times difference in growth. So in total returns, you see where it works into. Now, what happens if you invested $10,000 a year ago? Well, simple math, you'd have $12,403 in your fund, and DIVO would have $11,471, that $932 difference between the two. You do that over time or add a zero to these. You add a zero. If you invest $100,000 into this, you're talking yourself about $9,000, almost $9,300 difference between the two funds by selecting the one fund over another. Now, 1 year is not really the whole story. I got to give DIVO some credit here. Okay? DIVO's strategy wins in sideways markets, high volatility, and periods where blue chip leadership. The technical call generates more cash and more cushion in flatter markets, while Charles Schwab is strong market advances and dividend value leadership. Uncapped capital appreciation is more valuable than immediate income during bull runs. So you have two different funds, and they actually operate in two different periods of the economies. And so you can now, saying this, giving DIVO the credit that a 5-year history gives it a better advantage. Let me show you here total return history. I'm going to break this down. Year to date, look at this is giving you total returns. Charles Schwab is crushing it, 23.36 to 7.43. They're crushing it in 1 month, 4.79 to 1.93. Over the past year, 26.05 to 14.96. 5 years, DIVO steps in. So realistically, you take a look at the past, I'm going to call it the past 5 years. DIVO has won, but over the past year, Charles Schwab is walking away. Now, there's a combination of things that they don't tell you. Everything tells you. You got to do more research than this yet. Charles Schwab changed their strategy a little bit. They change every March. It's almost like they reset their portfolio. And their change this year made a huge change. It brought them back to life, I call it. They brought back, and some aggressiveness has happened. So here we are. The 1 year mark looks great on paper and probably going to look good for the second year, maybe even third year. Long term across the board, these two funds at 5-year mark, DIVO's winning. Now, Charles Schwab's been out there longer, so they have a 10-year mark. But let's go to inception. At inception, both of these guys are running basically neck and neck. 13.37 to 12.6. So long term, these two are very, very compatible. Currently short term, Charles Schwab has made changes to take over leadership once again. So which structure is actually better for growth? Well, I'm going to tell you straight out, Charles Schwab is. That no covered call ceiling, its uncapped upside, is definitely a huge advantage. The tactical cover side, which caps its growth, controls the growth side of DIVO, unfortunately. The expense ratios, are a big difference. And this is where I start coming back and saying we're maybe not comparing apples and apples, to be honest with you. DIVO, great account. And I think it fits in a lot of different people's growth packages because long term, very good. Short term, that one window period, Charles Schwab, you can see, is knocking it out of the park. If you want income with your growth, DIVO comes back into place. But the broader diversification, I think this is another big factor that people don't read into. And that is Charles Schwab's 100 plus holdings versus DIVO's only 33. I just give this thing wins, wins, wins across the board to Charles Schwab for what they have. Now, is Charles Schwab a complete growth bucket? Well, the answer is it's a diversified growth engine. It focuses on established large firms with massive cash flow and financial strength. It's best described as a dividend growth or a defensive equity growth rather than pure growth. So this is not one fund that you're going to take and say, 100% of my growth fund is in Charles Schwab. No, it's a good part of it. It can be a core. It can definitely be a core piece. But I wouldn't always say it's just 100% pure income. I just had a conversation with someone else and they said, I like this in my growth fund or I like it in my foundation bucket. And I said, I agree with you. It could be a foundation bucket. It could be in a growth bucket. And what blew his mind when I said this could actually be in an income bucket, and he didn't understand what I meant by this, is if you hold Charles Schwab for long periods of time, your buy-in number is going to be lower. And as the dividends grow, I see people getting 8, 9, 10% from their cost basis. Not dividends just off the books. It's from their cost basis. So this thing can be a multiplier in your buckets. Now, where does DIVO belong? DIVO is really an income specialist. That monthly cash flow, which is ideal for investors seeking distributions around that 4.8 per month. Now, it's a defensive buffer. It's a tactical covered call. It provides premium income and cushions flattened markets. It's an active selection, so you're going to get a lot of high quality large cap funds. Now, the income bucket, the primary role as a retirement paycheck, generate to cover living expenses. You need a lot of money to do this at 4.8. I'll just be honest with you. But at the same time, it does fit somewhere in income buckets. A hybrid allocation fits as a bridge between pure safety, cash, and pure growth in equities. And this is one that I've used as well. It's kind of one of these things it's hard to put it in a particular bucket. As though we always put in growth, I like this as putting my money, actually some of my money that I'm looking for that 4-5% return on. That's possibly in my foundation fund. It could be in my income fund. But I just got standing money. I like putting my money into this one as the hybrid allocation. So the volatility control, it's suitable for retirees who prefer low swings over maximum upside potential. So think about it as a 5% savings account. And, are you going to have some growth? It's shown for darn close, 5+ years. It's been a solid player as income. So let's give you the head-to-head scorecard. Investment style, passive, it's going to go to SCHD. That active with the covered calls, there's a reason for it. I just got to give the growth side to Charles Schwab. Yield, DIVO wins the yield game all the way through. Monthly payments versus quarterly, definitely stronger across the board. Expense ratios, you can't beat Charles Schwab at 0.06. It's almost doing it for free. The 12-month price appreciation, the 19% versus the 7%, huge. You're here for what? Winners. You're here for growth. 12% difference, big difference. Total return numbers, again, the real story comes out right there, but still talking about a 9.5% difference between the two. The best fit, I think Charles Schwab definitely goes into long capital appreciation growth bucket. DIVO, you can put it in the growth bucket, but you could also put it into an income bucket as well for that monthly cash flow. I just think as we started this off, which one's best for growth? Charles Schwab wins over DIVO all day long. So choosing your right retirement engine, this is just really comes down to you. What is it that you want? How do you want it? Should you put Charles Schwab into the growth fund? Should DIVO go into income? Should you put them in both? Could you use them in foundations? Let me know your thoughts in the comments below. You like the video we're doing, hit that like button. But I'm going to give you my final answer to this. I think Charles Schwab is the best growth champion across the board. I highly always recommend putting the Charles Schwab, putting whatever money I can into my Charles Schwab fund and let it grow. It's almost doing it for free. That 0.06 again is such a low expense ratio. And it's been doing this for well over 20 years. Okay, you're buying protection for 20 to 30 years. DIVO, I'm not against DIVO. And I really have a problem with DIVO, not itself, anything. I have a problem because in my buckets, I think it goes partially in my income bucket as a holding cash. I like it in my growth bucket by dripping that 4.8. And I also put it in my foundation bucket that, I have holding cash. I'm getting 4.8 on. I can't get that in a savings account. So there's a lot of different pieces to it. But I really believe it's the income specialist versus a growth specialist. Let me know in the comments below what you think. And guys, don't forget about all of our mugs, our license plates and everything, and our 40 ounces are back in stock. We got them ready to roll. Don't be afraid. Order them today. We'll get them shipped out to you tomorrow.